Howdy, Jacob here. Today we're looking at John Wiley and Sons, ticker symbol WLY. We see they have a $1.9 billion market cap on just under $2.8 billion enterprise value. They are in the media industry. Their current yield is just under the 4% we're looking for, but 3.9%, we're pretty much there. Revenue has been very slow growth. We see just under 1.8 billion in 2014. 10 years later, just over 2 billion. Return on invested capital on an average basis appears to be mid to upper single digits. So not terrible, but likely under their weighted average cost of capital. They're both margins have declined. That's a negative story. We see 14.3% in 2014, an operating margin down to 10.2%. And then gross margin of 71.4% 10 years ago, down to 65.7%. Looks like their dividend has actually gone up pretty consistently every year. It was $1 in 2014, and then it's now $1.39 in 2023. So the things I don't like, return on invested capital is going down, gross margin has been going down, operating margin has been going down. Let's see what they've been using with this. Well, first let's look at that balance sheet. So debt is $743 million long term, just $5 million short term on $107 million cash on hand. In relation to their 5-year average free cash flow, let's say is about 220 million. So on 220 million, they're paying out 77 million in dividends. They're recently paying a little bit in debt, paying down that debt, and then have been consistently paying a little bit for common stock repurchases, and then quite a bit in acquisitions. So the company's been growing through acquisitions, which is likely the reason for their decline in margins, with still an increase in revenue growth. I think I'm ready to make some assumptions here. Let's see. So even with acquisitions, they might grow 1% a year for the next 10 years. And then without acquisitions, they don't really have any growth potential. So I'm putting them at a 7-year from now PE, price to free cash flow. I do like that free cash flow margins have been consistently higher, but still it's not that great, I guess. A 2% increase of debt on their 743 million would be about 16 million, which is no real hit on their free cash flow margin. So I'm not even gonna really impend them for that. So I'll just do an average, pretty much 6%. 12. Let's do 6, 11. Maybe they buy back 0.5% of shares. And then as for the dividend, I think they can afford what they have right now based on free cash flow. It's just whether they're going to focus more money on paying a dividend versus growth through acquisition. So I will say that, let's say they grow 2% a year on their dividend, then we still get to a price that's not entirely close to what we're looking for. We're saying that the stock price is going to have to fall 52% before we get a 15% return given these assumptions. It is in the media industry. Their growth is very small, if anything, and it looks like their growth has been consistently through acquisitions. And through growing with acquisitions, their margins in return on invested capital has been going down. So those are the negatives, but the price, I could easily see it be a price that makes sense to some people. I think that this dividend makes a lot of sense. It's affordable for their free cash flow that I'm seeing. And so I think this would be a company to do more research on. I don't think that debt is necessarily a concern given their 5-year average free cash flow is about it's under 4 years of their 5-year average free cash flow, which is not entirely concerning. You'll just have to look at when that debt is due if you're interested in buying into this business, but I won't be doing more research for a little bit as it needs to fall quite a bit before a 15% return given these assumptions. So hope everyone enjoyed the video and has a great rest of your day. Thank you.